How do operations management teams in private equity create value? Management teams and operational management. The design phase, controlling, supervising manufacturing and service provision, is known as operations management. Operational planning is fundamental in a business since it aids in the effective performance, management and supervision of commodities, processes and employees. But first, if you are new here, consider subscribing to this channel to continue receiving great weekly videos on consulting. Don't forget to hit that notification bell so that you can get informed every time I publish a new video. An active team is formed to carry out various ongoing tasks necessary for the delivery of the product. While project managers are more familiar with the concept of team members, an interdisciplinary manager also requires a diverse group of people to assist the team's procedures and achievements. To maintain efficient daily operations management, service team members oversee a broad staff in enterprises. They put policies and plans in place, provide efficient service quality, and supervise structure, mechanical and equipment maintenance. Management team, often known as supply chain management, is particularly crucial in program development. The objective is complicated: to maximize the quality of service, simultaneously regulating and cutting expenses. Organizing the behavior of individuals who were kept separate from one another entails dealing with various scheduling and connectivity concerns that are not encountered within employees. Companies that seek to improve the effectiveness of existing goods and service manufacturing processes can turn to the operational upper management for a tailored set of activities. Private equity teams. Private equity is a type of firm which includes expenses that is traded on the industry. Instead, these firms or stakeholders make investments in commercial companies, culminating in the revocation of the stock exchange. The funds can support modern approaches, make acquisitions, grow capital expenditure, boost and strengthen a cash flow. Vital objectives for both investment banking portfolio managers and operational management of companies in the portfolios. Proactive utilization debt that offers financial and favorable tax treatment. Deliberate focus on profitability is all elements that contribute to managing good yields. Advantages. Venture capital benefits firms and entrepreneurs in a range of methods. For starters, industries consider it because it offers stability as an alternative to standard operational activities such as modest bank loans or industry placements. For example, investment funds are a sort of private equity that engages in new businesses and ideas. In the case of suspending enterprises, private equity capital may help them in adopting unusual strategic strategies that are not subject to market scrutiny. A private equity group may reorganize the outstanding stock, appoint a new leadership team, and make additional administrative reforms to grow leads in certain circumstances. When a private equity group participates in a business, it hopes to increase the asset class value. Buying a firm in a financial crisis due to poor leadership, underinvestment or other issues is the old version, the one that attracts the most publicity. How do private equity firms make money? Private equity companies have been labeled numerous categories. Although each has its unique financial strategy and method, they all have the same objective: to generate wealth for their shareholders. A frequent misunderstanding is that private equity firms build value through investment and reckless debt loading their business units. In practice, these techniques frequently depreciate the corporation's worth and the investor's equity. When a private equity firm participates in a firm, they do so with the expectation of increasing the portfolio's value. Acquisition of a corporation in an economic meltdown due to poor leadership, lack of resources, or even other circumstances is the classic model and attracts its most attention. Operation team in terms of private equity. Private equity firms are usually taken as employing their industry experience and technical understanding to find decent assets, develop asset strategy, and conduct wealth generation plans to produce attractive value creation. Even though valuation proposals are mentioned in various studies, there seems to be no accurate data about what these interventions look like or whether they help enhance groups that represent all shareholders' profits. In a recent study, researchers used classified data on wealth creation proposals and their implementation to access the liberal box of wealth generation in private equity. They discovered that programs are adapted to the needs and conditions of each portfolio company, and that they have grown more virtual. Participant profits are driven by successful implementation, which differs consistently between funds. Even after private equity funds have exited, business activities and earnings improve in a way that are consistent with great production. When creating influential, elevated companies, private equity firms have numerous benefits. Along with a constructed platform for transformation, tightly aligned possession, and compensatory damages designs, and lesser organizational allegiances and competitive interruptions. Despite these differences, the highest level private equity firm success factors offer essential and widely applicable learning. To establish a value generation routine, public firms can borrow the following personal equity requirements. Maintain a laser-like concentration on quality. Private equity companies must retain a laser-like ability to generate profit in working groups. Despite mere investment banking and aggressive cost reductions in terms of attracting money from individual liability, a growing number of private equity purchases have included significant organizational benefits of many operational management companies due to this approach of extensive industrial and functional expertise. Private equity firms are in the pits with their business units, investing in critical operations and eliminating non-essential costs. Risk assessment is the starting point for private equity firms' concentration on fundamental value. Trustees carefully select each target organization and specify how and when they will add immediate benefit to their management companies. This evaluation does not end with the purchase. Keep in mind that money is power. Private equity firms usually use loans to fund 60 to 80% of acquisitions. This moderate model instills in private companies a sense of immediacy and emphasis on releasing and generating money as soon as possible. Private equity firms tighten their collections and receivables management, minimize inventory, and evaluate unnecessary expenditure to increase income stream, save money. Public corporations or management groups can learn to form private equity and implement a comparable quality improvement strategy. Although the specifics would differ from one organization to another, any such system will boost earnings and improve working capital in active management groups. Treat time as if this were cash. The philosophy of private equity companies is money is valuable, which is compatible with the need to create cash rapidly to pay off debt. The 2-month program that private equity firms typically enforce on business units in the first few months of management exemplifies this bias towards activity. In addition, many prominent public corporations value socialization and consensus building, but private equity firms have a limited desire for it. As a result, private equity firms and their management teams feel pressed for time and make quick changes. For operating groups, use a lengthy perspective. Private equity firms operate quickly but not at the expense of thorough study and deliberation. Investors usually possess 3 to 5 years to invest their cash, especially for staff or group, giving them plenty of time to evaluate possible targets and formulate an investing strategy in a working group. After that, private equity firms have a period to leave these transactions and repay the profits to shareholders. Private equity firms do not typically swap investments, despite what some may assert. Instead, the limited partners can manage to plan for the extended value-creating capabilities of the business. They own after obtaining the brief cost savings of reducing low-value operations reality, persuading a purchaser that they have structured the organization for future productivity. This expansion seems to be the only method managers of the working groups would secure their planned profits upon withdrawal for a simple operational management team method. The top private equity firms don't just slash costs, they also invest in the most promising fundamental value creation initiatives. The capacity to make these sensible decisions is a theory and practice that public firms can master. Put together the right team. A private equity firm will take decisive action to hire the best leader and management staff possible for the value creation of operation management teams. It may depend on its in-house expertise or an external network to cover skills shortages. Private equity majority shareholders instinctively recognize that robust and effective leadership is vital to the success of their venture. In addition, they may choose to participate in a firm based on its leadership skills. The evaluation of ability starts as early as proper research starts and continues after the deal is closed. Choices are rapidly carried out after they have been taken. Link compensation and accomplishment. Private equity companies pay their portfolio business executives modest base salaries. Still, they also receive highly variable and yearly incentives based on business and personal success and a lengthy incentives reward system related to the exit profits. The board and senior executives of a private equity portfolio company are heavily involved in the success of its organization. Their riches rise when the company succeeds and plummet when it fails to meet its goals. This package usually consists of shares and choices, which could be pretty expensive, particularly for executives. Moreover, even though publicly traded companies do not have the same freedoms as private companies with a high concentration of ownership, their board members and directors can benefit from private equity firms' best practices by adjusting people to the complexities and restrictions of their company process to improve additional and long-term value. There are reasons why those who can afford the upper management charges continue to participate in private equity. First, the facts show that the best of such firms consistently and financially benefit to their business units by executing genuine and long-term operational and income improvements. If you like the video, give us a like so we can make more videos like this one, and tell us in the comments section below what type of videos you want. Lastly, don't forget to subscribe to the channel for more weekly videos.